Welcome to our comprehensive guide on Minnesota tax residency. If you're planning to move to the North Star State, or even if you split your time between several locations, understanding Minnesota's residency requirements is essential. Your tax residency status fundamentally affects your financial obligations, and knowing how to navigate this complex landscape is vital to avoid unexpected tax bills. This video will empower you with the knowledge you need to establish and maintain your tax residency confidently, optimizing your financial situation in Minnesota. Let's start by defining what tax residency means in Minnesota. Your tax residency determines which state can tax your entire income, making it a critical aspect of your financial planning. Minnesota has one of the higher individual income tax rates in the country, ranging from 5.35% to as much as 9.85% depending on your income bracket. Thus, understanding whether you qualify as a resident for tax purposes is not only wise but necessary, as it greatly influences your financial responsibilities. When determining residency in Minnesota, there are primarily two tests you need to consider: the domicile test and the physical presence test. Your domicile is your permanent legal home, the place you intend to return to after any temporary absences. It's vital to have a clear understanding of this concept, as establishing your domicile requires more than just living in Minnesota. It involves having strong connections to the state, and the Minnesota Department of Revenue looks at various factors to evaluate this. If you plan to change your domicile, you'll have to demonstrate this shift with concrete actions. The second pathway to establishing Minnesota residency involves the physical presence test, famously known as the 183-day rule. If you maintain an abode in Minnesota and spend at least 183 days in the state within a tax year, you are considered a resident, regardless of where your legal domicile is. It's crucial to keep meticulous records of your presence in Minnesota because any part of a day counts towards this total. This strict rule means that if you are nearing this threshold, you'll want to track your days meticulously to avoid unintentional tax implications. Finally, let's touch on some common residency scenarios that can complicate tax considerations, such as being a snowbird or a remote worker. Snowbirds often split their time between Minnesota and warmer states, and it's essential for them to track their days to ensure compliance with residency requirements. Similarly, remote workers should be aware that working from Minnesota could subject them to state taxes, even if their employers are located elsewhere. Understanding these scenarios, maintaining documentation, and employing strategies for tax planning can make a significant difference in your financial outcomes as a Minnesota